Good days to total. Our group will be presenting on conventional loans and sukuk, which are important fixed income instruments used by governments and corporations to raise funds. Although both instruments serve a similar financing purpose, they differ significantly in terms of structures, returns mechanisms, and underlying principles. In these presentations, we aim to highlight these key differences and explain how sukuk functions as a sharia compliance alternative to conventional bonds in modern financial market.
My name is Jin Hui En, and I will be presenting this part of methodology. So, to ensure a meaningful comparison between CIMB's conventional bond and Sukuk, instruments were selected based on the relevance, data availability, and representation of both debt markets. Resin issuance by CIMB Group and CIMB Islamic Bank were used to reflect the real market conditions rather than the theoretical assumptions. Specifically, the 250 million sukuk and a medium-term note with similar yields provide a balanced basis to compare the investor demand, pricing, and compliance requirements. Information was obtained from credible financial news sources such as The Age Malaysia, along with academic journals and educational websites. This approach ensures the analysis is supported by both actual issuance data and established theoretical insight.
Good day, Doctor. I'm Nicole Angtianshe and my matrix number is 292490. Now I will be discussing with comparative profile. On the left is a conventional bond, known as CIMB Bank MTN3652D, maturing on 18 May 2027. On the right is the Sukuk Murabaha, CIMBI 4.55% with a maturity date of 21 September 2026. Both instruments are corporate instruments, meaning that they are issued by CIMB and carry similar related issuer risk. Each instrument also has its own ISIN code and stock code, which are used for the identifications and trading in the market. In terms of classification, the conventional bond is issued as a medium-term note, while the Sukuk Murabaha is classified under Islamic bond or I-bonds, reflecting its Sharia compliant structure.
Now I would like to continue the presentation with instruments different for both conventional bond and sukuk murabaha. In terms of return, the conventional bond offers a fixed interest rate of 4.7% per annum, while the sukuk murabaha provides a fixed profit rate of 4.55% per annum. Since both rates are fixed, they offer the predictable income to investors. When we look at the payment structure, both the conventional bonds and the sukuk murabaha make their payment on a semi-annual basis, meaning that investors will receive their return in twice a year. However, the most important distinction lies in their underlying structure. The conventional bond represents a straightforward debt obligation where returns are generated through interest payment. In contrast, the sukuk murabaha is structured based on the Islamic financing principle where returns are derived from the asset-based transaction rather than interest, making it compliant with the Sharia principle. In terms of tenure, both instruments have a duration of approximately 10.01 years, which places them in the category of long-term debt instruments with similar investment horizon. Looking at the issuance and maturity period, the conventional bond was issued on 18 May 2017 and will mature on 18 May 2027. Meanwhile, the Sukuk Murabaha was issued earlier on 21 September 2016 and will mature on 21 September 2026. Despite the different issue date, both instruments provide a comparable overall tenure. From a classification perspective, both instruments fall under the non-SRI and ASEA bond category, indicating that they are not issued under the sustainable or socially responsible investment framework. Overall, while both instruments share similarities in terms of tenure, payment frequency, issuer profile, and the return characteristic, their constructural foundation differ, distinguishing the conventional and Islamic debt instrument.
This part of the analysis compare a conventional bond and a sukuk issued by the same banking group using a standard market-based interest rate. I got the issue price and the coupon rate for the both instruments from BIX Malaysia. Since both were issued at par value 100, the coupon rate is equal to the yield at issuance, which is YTM. That means the bond have yield of 4.7% and the sukuk has yield of 4.55%. According to Bank Negara Malaysia, the benchmark used is the 10 years Malaysian Government Security MGS trading yield, which was 3.58% at market close. This benchmark reflects the current risk-free rate in the Malaysian bond market. To calculate the credit spread, we subtract the benchmark yield from the yield at issuance. For the conventional bond, the credit spread is 1.12%, and for the sukuk, it's slightly lower at 0.97%. This shows that the investor requires a higher premium for the conventional bond to cover the risks like credit risk, liquidity risk, and other non-sovereign factors. In the other hand, the sukuk lower credit spread suggests that investors see it as slightly less risky or more attractive, even though both insurance are issued by banks within the same group.
My name is Annapurni Ganesan, and I'll be presenting the performance analysis of the two CIMB instruments. The first one is CIMB Medium Term Note and followed by the CIMB Sukuk. So let me begin with the CIMB MTN. Starting with the price behavior, the MTN traded with a narrow range of 99.889 to 100.062 ringgit, which indicates strong price stability around par value. This suggests efficient pricing and limited market uncertainty. In terms of yield stability, the bond recorded an average yield of approximately 4.70%. The yields remained relatively stable throughout the period, reflecting consistent investor confidence under normal market conditions. Now, looking at the credit spread, the MTN carries a 1.12% spread over the 10-year Malaysian government securities, which yields about 3.58%. This moderate spread appropriately compensates investor for CIMB credit risk and aligns with the solid credit profile. Moving to risk and liquidity indicators, the MTN shows low volatility with a standard deviation of 0.044, indicating minimal price fluctuations. Liquidity remains adequate with a constant bid-ask spread of 0.595 points, suggesting steady secondary market trading. Finally, in terms of interest rate sensitivity, the bond has a Macaulay duration of 8.12 years and a modified duration of 7.94 years, implying moderate sensitivity to interest rate changes. The trading pattern as well recorded 10 upward movements, 8 downward movements, and 3 unchanged movements, reflecting balanced market activity. Overall, the CIMB MTN demonstrates stable pricing with a low risk and predictable returns. Now I will move on to the CIMB Sukuk, starting with price behavior. The Sukuk traded between 99.543 ringgit and 100.029 ringgit. Although there were slight fluctuations, prices remained close to par, indicating tight trading and strong post-issuance demand. For yield stability, the Sukuk recorded an average yield of 4.55%. The yields move inversely with price, which is consistent with bond pricing theory and reflects stable credit expectations in the market. In terms of credit spread, the Sukuk offers a 0.98% spread above government benchmarks. This indicates strong investor confidence and reflects CIMB high credit quality under Sharia compliant financing. Looking at volatility and liquidity, the Sukuk shows a higher volatility of 0.107, suggesting a slightly more price movement compared to the other one. However, liquidity is very strong, supported by a tight bid-ask spread of only 0.100 points, indicating active trading and high market efficiency. For duration, the Sukuk has a Macaulay duration of 8.19 years and a modified duration of 7.99 years, which is marginally higher than the other one, making it slightly more sensitive to the interest rate changes. The trading pattern shows 12 upward movements, 4 downward movements, and 3 unchanged dates, indicating a generally positive market trend. In summary, the CIMB Sukuk demonstrates strong liquidity, competitive yield, and robust market demand, making it an attractive Sharia-compliant investment.
I will present the comparative evaluation between the CIMB conventional bond (MTN) and the CIMB Sukuk Murabahah. First, in terms of coupon and pricing, the conventional bond offers a slightly higher coupon rate of 4.70% compared to 4.55% for the Sukuk. However, when we look at the credit spread over the 10-year Malaysian government securities, the Sukuk has a narrower spread of 0.97% compared to 1.12% for the conventional bond. This indicates that the investor require a lower risk premium for the Sukuk. Next, regarding liquidity, the Sukuk clearly outperformed the conventional bond. The BR spread for the Sukuk is only 0.100 points, showing tighter spread and lower transaction costs, while the conventional bond has a wider spread of 0.595 points, indicating relatively higher trading costs. In terms of investor demand and market perception, the conventional bond mainly attract traditional fixed income investor and is considered fairly priced. In contrast, the Sukuk benefit from strong demand from Islamic and ESG focused investor, which allow it to be priced at premium despite the lower yield. Overall, this comparison shows that the Sukuk Murabaha outperformed the conventional bond in pricing efficiency and liquidity, reflecting stronger investor demand and a Sharia compliance premium, which ultimately allows CIMB to raise fund at lower cost.
Let's move to the conclusion of our analysis comparing CIMB's conventional bond and Sukuk Murabaha. Our key findings clearly shows that the Sukuk was most favorable instrument at the time of issuance. It was issued with a lower coupon rate of 4.55% compared to the 4.70% for the bond and carried a narrower credit spread of 0.97% over the Malaysian government security benchmark versus 1.12% for the conventional bond. So this indicates stronger investor demand and a lower cost of capital for the issuers. In terms of performance, the Sukuk demonstrated higher liquidity in the secondary market with tighter bid-ask spread and more consistent upward price movement. So this reflects sustained investor confidence and market support. So, why did the Sukuk outperform? There are three main reasons. Firstly, its Sharia compliant structure attracts a dedicated investor base, including Islamic financial institution and ESG focused funds. Secondly, its asset backed nature reduces perceived risk and enhances trust. And thirdly, the resulting demand premium allows issuers like CIMB to raise funds more cheaply. Therefore, our investment recommendation is clear. For issuers looking to raise capital in a cost-effective and ethically aligned manner, Sukuk Murabaha present a compelling options. For investors, it offers a stable, Sharia-compliant instrument with a favorably liquidity and yield characteristics. In summary, the Sukuk not only provide CIMB with the cheaper funding but also strengthen its strategic position in the Islamic finance market. Thank you.